Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today is Michael Becker.
Hey, Paul.
Michael, what's been probably the most toughest thing going on in politics and the economy these days?
One of the most topical things is the tax reform, which just got passed.
The tax reform has been probably the most difficult thing that, I've done this for a long period of time. Last time that any major tax reform was done was in 1986. And so I didn't think it was going to happen, but it has happened. And we're going to bring in some of our CPAs to talk a little bit about what's going on. Consult your own CPA, but we want to give you some bottom line, great information about what's going on for business owners and how it does affect real estate. But before we get into that, I just want to remind everybody on February the 15th, what's going on, Michael?
February 15th, we're going to have a economist, David Kahn from CoStar is going to come out and speak at the Grapevine Convention Center about, 6:30 or so, Paul?
6:30, 7 o'clock. So Grapevine Convention Center between Dallas and Fort Worth. We'll probably have about 150, 200 people there. Great opportunity to network. David, who is with CoStar is a great data collector of what's going on in multifamily, office, and retail. But his focus is going to be, as an economist, this guy went to Johns Hopkins, kind of knows what's going on with multifamily, a great source of data. He's the guy who writes most of the reports on multifamily in the Dallas-Fort Worth and the Texas area. So some great information. So we're looking forward to seeing that talk coming on February the 15th. Go to the Old Capital podcast and you'll be able to register for that event. It's a free event. We should charge $100, but it's a free event. But you want to make sure that you do participate in that. And then, Michael, what else?
And we're also going to have Dr. Dotzauer on March 28th at the Grapevine Convention Center as well. And we'll probably have 400 or 500 people at that one, which is great. He's a very entertaining economist, talk a little bit more national and Texas-specific economy news. So he's a great guy. We had him out last year and had 400 people plus come here and speak.
You definitely want to hear that, especially if you're making investments in Texas, not only just Texas, but on the national piece too, because he talks a little bit about what's going on with commercial real estate on the national basis. So if you're in Dallas or you're thinking about coming through, you definitely want to get into the Grapevine Convention Center and watch Dr. Dotzauer and take some of his information to heart when you make investments. The gentleman and the lady in this podcast are special to us. We had them on about 6 months ago, and they, as we said, we probably didn't think tax reform was going to happen. I think Mark concurred with me. I didn't think it was going to happen, but by golly, it did happen. So let's kind of talk a little bit about what's going on. So I want to welcome to the podcast Mandy and Mark. So guys, thanks for coming in. We appreciate that.
Thank
Paul.
you.
So Mike, I'm going to kick this over to you because you love talking about taxes.
I do. So maybe we start quick with a quick background. I know we had you guys on a little less than a year ago, I think it was. So you can certainly go back and check the back episodes and listen to it. But Mark, maybe you could give us a quick background on yourself and your firm.
Sure. So I'm Mark Patton. I'm a CPA in Dallas, Texas. I have a CPA firm called McKinnon Patton. We're in Dallas for 50 years, and we serve owner-entrepreneur businesses primarily. We do a lot of tax work related to real estate, investments, oil and gas, agriculture. And most of our clients are owner-entrepreneurs, and we think they're going to see a big benefit from the tax reform.
Mandy?
I'm Mandy Thibault, a CPA as well. My background is varied with public accounting and corporate accounting experience. I've owned my own firm and my own business, so I understand both the business side and individual side of things. And I've been with McKinnon Patton for a year and a half now, I'd say. But I've been working with Mark for about 5 years.
Well, great. So the topic really we want to talk about is kind of the Tax Reform Act and kind of talk through some of the changes. And most of the audience that listens to us is not too dissimilar from me. They either invest in real estate or they're the leads in apartment complexes primarily. So maybe kind of just talk through a little bit some of the kind of the macro changes and we kind of get a little bit more granular on the different aspects of it. Mark, I'll kick it over to you.
Sure. there have been a lot of headlines about tax reform, and a lot of those are really focused on personal taxes. So we've seen, you see a lot of headlines about property tax deduction being limited, and saw a lot of people scrambling at year end to try to prepay property tax, and a number of other things. But what we really want to talk about is tax reform as it relates to business and real estate tax issues. So I'm going to throw out a few code sections and things like that, but we'll try to make it accessible and try to benefit the listeners, especially as it relates to real estate tax issues. So the really great aspect of this tax reform bill is something called Section 199A. It's also known as the Qualified Business Income Deduction, and it's a really big deal. So we've heard practitioners in our profession say that it's the biggest tax break afforded to small business owners in the last 50 years. So it's a great deal. The headline impact is that for entrepreneurs and investors, the deduction, this 199A qualified business deduction, allows the small business owner to not pay tax on about 20% of their business income. So somebody with $1 million of pass-through income can use the deduction to avoid paying tax on about $200,000 of that income.
And that's the net income that they get to deduct that off of. Is that correct?
Yes.
Good. Okay.
So that's business income. And I'll get into the details and the key concepts. There are flies in the ointment, however, and those are that the code section itself is really tricky. There are a bunch of rules that owners are going to have to know and manage, and there's going to be some complex accounting associated with the rule, but the benefit is definitely worth it. So I'm just going to throw out a few basic concepts here. Also, the headline has been that corporate taxes have been reduced down to 21%, and that's true. So this deduction, the 199A deduction, benefits owners of pass-through entities, so unincorporated businesses that are not C Corp. So think sole proprietorships, partnerships, S Corps, LLCs, single-member LLCs, multi-member LLCs. So it's really for pass-through entities. The second key concept is that the QBI deduction shelters business income. So here you want to think about income statement. So revenue less expenses, wages, depreciation, interest, et cetera. It doesn't shelter income that's already taxed at a low tax rate. So this QBI does not include capital gains or dividends. So the good news for real estate investors, though, is that the QBI treats net rental income shown on Schedule E as qualified business income. So the deduction is available for net rental income. So let's, as an example, if you're a real estate investor, you got 3 rental properties. 1 generates $10,000 net rental income, 2 generates $20,000, and the third throws off a loss of $5,000. So you have total net rental income of $25,000. The deduction is going to be 20% of that, so $5,000. And again, it's not a one-time deduction. It's an annual deduction. It's an annuity. The third key concept, which I refer to as flies in the ointment, the bill benefits, or the bigger the benefit, the more complex the rules. So Congress made the QBI deduction pretty easy to take for most people, but the rules get more complex as the taxpayer's income grows. So who is a high-income taxpayer for purposes of this deduction? So it generally refers to taxpayers who are married filing jointly with taxable income of greater than $315,000, or single taxpayers with taxable income of greater than $157,500,000. So anybody below that's going to pretty easily be able to take this deduction pretty easily.
So if you make more than that, what happens? Are you just phased out, or is it a hard stop?
There's a phase out, and then there's a hard stop. And there's a bunch of limitations that start knocking down that deduction. I'm about to take you through those.
Okay.
And it could be pretty mind-numbing, so get ready. Just talk about some of the basics related to the deduction. So the timing, so the deduction is available for 2018, so it's not on the 2017 return. Unfortunately, the deduction sunsets in 2025. So it goes away unless Congress extends it at the end of 2025. Geography. So this is kind of for the tax nerds. But it also helps you think about what this deduction is and where it shows up. So tax nerds call these types of deductions below the line deductions, and the deduction is effectively or acts like a standard deduction. So it's going to reduce your adjusted gross income on your individual tax return. So you'll see this deduction show up on page 2 of the tax return. So now I get to So the rules, so the limitations. So this is for high income taxpayers. So the deduction is not available for high earners with businesses that are considered service, trade, or business. So, the code, think about white collar professions. So businesses in the field of health, law, accounting, performing arts, consulting, athletes, brokers, and there's just a general catch-all that says any trade or business where the principal asset is the skill or reputation of more than one or more employees. So our reading of this is that real estate brokers that are high income won't get this deduction.
Okay.
But if you're a real estate broker and your taxable income is under, or say $200,000 or under $315,000, married filing jointly, you'll get the deduction. There's a complication. So let's say we have businesses that have multiple types of activities. So if you have a business, let's say you have a pass-through entity that has both consulting income and also you're selling something. So you have consulting income on software, but then you have software that you sell through this entity. So you're going to have to break that out and allocate that income to the different pieces so that you're going to be able to take advantage of the QBI deduction.
So how does that work? So most people here are real estate professionals, and that's kind of what I do, or passive investors in it. So as a real estate professional, when you're just going out and you're a syndicator raising capital, how would this be applicable to you? And then if you're just a passive investor who just simply invests alongside in a syndication, are these rules treated differently for people like that versus kind of what you just referenced for a high income broker or lawyer or someone along those lines?
So there's no difference between passive and active activity here. So let's say you're a real estate broker, you also do syndications, and you also independently own proportional interests in real estate partnerships. So all those separate activities and their separate entities would have a separate calculation for the QBI deduction. So you basically go to the entity level and do this calculation. So at the entity level, you say, okay, let's start off with what is the qualified business income? What is the net income of this entity and this activity? And then is it a specified service business? If yes, then you look back to the taxpayer's taxable income. If no, then you keep going. And so there are decision trees. So we have access to decision trees. We're building models. We're working with clients right now, estimating what their tax savings are going to be from their business activity.
But a standard real estate, so if I just passively invest $100,000 in a deal and I own 5% of an apartment complex, any that owns an apartment complex, and I make over $315,000, it's really what my personal income is that really would allow me to either be able to benefit from this tax savings or not. And then another person invests in the same apartment complex. It really just flows through by the individual's personal tax situations more than what's going on with the entity that owns the apartment complex, correct?
It's both.
Both?
Because I haven't gotten to the second set of
I'll cut you off. Well, that's a good transition once you get to there.
But it's both. So it's complicated. So it looks both to the taxpayer's taxable income, but then also looks at the activity at the entity level. What is the activity type? What type of business is it? Is it a service business? And or does it have employees, and does it have depreciable assets? So there's a second set of limitations for this deduction. And so for high income taxpayers, the deduction is going to look at wages and depreciable property at the entity level. So what are wages? And the code is very specific here. And it's wages are W-2 wages for the employer and the employee. This does not include guaranteed payments or any other types of payments, 1099 payments. This is W-2 wages that are reported to the Social Security Administration. So you could already kind of fast forward that the Congress is looking to benefit entities and types of businesses that pay people and that employ a lot of employees and have assets. So the second limitation is that at the entity level, it looks towards the amount of depreciable property, so at the original cost. So the unadjusted basis of the depreciable property used in the business. So we talked about the specified service limitation. The second limitation is that the deduction gets limited to 50% of wages paid by the entity or 25% of wages plus 2.5% of the original cost of the property used in the business.
So 2.5% of the original cost. So if we buy a $10 million apartment complex, you can have $250,000
Right.
of deduction due to that, correct?
Yeah. So I know nobody can follow that. So you want to do an example?
Sure.
All right, let's do an example. So let's say you got a taxpayer. Taxpayer individually reports $500,000 of taxable income. So this taxpayer owns one multifamily rental property in an LLC. So the net income for that multifamily rental property from that LLC is $200,000. So the headline deduction on that rental properties is $40,000. So 20% times $200,000. But because this guy's high income, so we got to start looking at the limitations. So the first limitation is looking at W-2 wages. Let's say there's no W-2 wages at the property, right? So this entity just uses a property manager, doesn't hire anybody, no independent employees, no W-2 wages.
Okay.
So 50% of zero is zero. Then you look to the depreciable property. So let's say the unadjusted basis of the apartment complex, not including land, is $200,000. So the second calculation is basically 2.5% of $200,000 or $50,000.
Okay.
Right. So that's the limit, but the limit's already $40,000. So you're at 20% times $200,000. So this taxpayer gets a $20,000 deduction for this activity.
Okay.
Pretty complicated. We've done a lot of these calculations so far. We're sitting down with clients and we're having clients say, hey, I want to give my clients or my employees a bonus. What is my tax savings for the year?
Okay. That is complicated.
It's a tough one. And that's just for one entity.
Yeah.
Right. So I'm sure a lot of listeners on the podcast have multiple entities. So they're partners in limited partnerships, and they have 5K1s.
So how does that work? So say if I'm a partner and I have 5K1s, then who's responsible for making that test? So, typically as a sponsor, I'll just deliver my K1s and then it kind of goes away. Am I going to expect future touches with everyone to do some sort of tax accounting with them over email, or how's this going to kind of go forward?
So the short answer is we don't know yet because it's early days and there's, the tax bill was pushed through pretty quickly. And so we're still waiting for the IRS to provide guidance on how to administer this section. But, what we think we're going to see is because the calculation starts at the entity level so that every K1 we imagine is going to report additional information. So not just net rental income, but also what W-2 wages were paid at the entity level and what the amount of depreciable property is.
Got it. So we'll probably have an extra box on the K1 that'll solve this problem going forward.
Yeah.
Okay.
Multiple boxes, we're thinking. And so if you have multiple entities, then these things are going to stack up and report to you on your Schedule E.
Got it. Yeah, and it'll flow down. So this is a 2018 tax problem, not a 2017 tax problem.
Right.
So for this year, it's pretty much status quo.
For 2017, yes.
Yeah, cool.
So this is a 2018 issue, but we're front running it right now. The last issue is, so we're not really sure how this is going to apply to tiered entities. So this is the Russian doll of entities. So you have a trust that owns a limited partnership that owns multiple limited partnerships and LLCs and S-corps and things like that. We're still waiting on guidance on how it rolls up through a tiered entity structure to the individual taxpayer.
Okay. Stay tuned. So that makes sense. So there's any sort of like limitations, I guess, as far as being active or passive in the deal with this?
No. So the deduction's available to you if you're active or passive.
Okay. Good. So one of the other things I've heard quite a bit about was something that's certainly of utmost importance to me is when we buy these deals, and we typically do cost segregation studies when we buy apartments to try to break the building down its components and be able to accelerate the depreciation versus taking the standard 27.5-year straight line method on a residential building. So Mandy, I've heard that they had changed some of the rules with bonus depreciation and was it Section 179 depreciation. So maybe kind of talk through that. So what were some of the changes that were enacted within the law regarding depreciation and bonus depreciation?
Sure. So bonus depreciation, or the special depreciation allowance, under the old law, it had to be new property. So the cost of that new property in the year that you place it in service, you could deduct 50% of it. Under the new law, it can be new or used property. And so that's where the cost seg study comes into play. you purchase an existing property in, say, 2018, and you cost seg it, you get your 5, 7-year, 15-year, 27.5-year property. Under the old law, you couldn't take any special depreciation allowance on it. Under the new law, though, you can. And also under the new law, it's not just 50%. You get 100%.
So you could take an apartment building, you allocate 15, 20% of the purchase price. So say you buy a $10 million apartment building, you take 20% to land, and you have $8 million, and you break that down, you can get, of that $8 million of depreciable base, you can get, $3 million-ish in either 5, 7, or 15-year period. And you're saying now that $3 million can be written off in the first year, potentially?
Correct. Yes. And it is 100% write-off in the year. It actually starts. This is one thing that you can back it up into 2017. I just realized this working on a 17 tax return. So any property placed in service after September 27th of 2017, you can go ahead and take this 100% deduction.
So we can write off potentially, upwards of 30% of the purchase price of a building in the first year, something along those lines.
Correct.
It's amazing. So what happens when you sell it? What happens to that money when you recapture it?
Mark, do you want to?
Yeah, so that income comes back, and it's called depreciation recapture. So it comes back to you as ordinary income. So it's interesting. This ordinary income would then flow into this, would be considered qualified business income for purposes of this 199A deduction. So Mandy's talking about expenses and generating losses, and I spent the first part of the talk referencing income and basically a deduction against income. So anyway, that depreciation recapture, we believe, will flow back through as ordinary income, and you can take the deduction against that income.
But is depreciation recapture the way it currently is capped at 25%? Is that still going to be the same?
Yes.
So
that didn't change.
So if you're a high income earner, instead of what the top tax threshold now is, 37%? Is that correct?
Correct.
So you would have a 12% break through depreciation recapture if you're a high income earner. So it's still advantageous if you're a high income earner to make sure you go in and accelerate as much as depreciation as you can, correct?
Correct.
And then if you can't use it, it just is suspended and carried forward for future use, essentially.
Yes.
And then if you're a real estate professional, then you can take that off all your active income.
Yes. And I will say that, so one twist of the QBI deduction is that when calculating net rental income on Schedule C, again, Schedule C, tax nerds, sorry, the passive losses are going to be activated. So to the extent that prior passive losses have been suspended and then they're activated in the year that you have income, then that'll reduce your net rental income and then reduce your QBI deduction.
Got it.
So there's a fair amount of moving parts here.
Is there anything else with the bonus depreciation or anything else that we haven't talked about relating to the subject matter?
Well, and to clarify, so that 100% phases out. It drops by 20% starting in 2023 and drops down to 20% by 2026.
So it drops down 20% a year starting in 2023.
Yes.
Got it. Okay. Makes it complicated as well.
Yes.
So, okay. Has there been any changes to? I know one of the headlines was about interest expense and maybe potentially not being able to take that. Has there been any changes with the interest, the way you could deduct it or not deduct it?
So there's a business interest deduction now, and there are limitations. It's applied to businesses with average gross receipts exceeding $25 million.
Okay.
So as long as you don't exceed $25 million, you're exempt from this limitation. And so what it does is it disallows interest expense in excess of 30% of a business's adjusted taxable income.
So what does that mean in English?
So right now what we're seeing is basically the net income without consideration for depreciation, amortization, or depletion. But we're waiting for more guidance.
Does that affect a business that is primarily like a real estate business, like someone that owns an apartment complex, for example, or are those exempt from this rule as well?
It would apply to them most definitely because they would incur, I would imagine, lots of interest expense.
Yeah, got it. So, but as so long as your gross receipts for that entity is less than $25 million, you're exempt?
Correct.
Got it. Okay.
Correct. And the disallowed interest carries forward indefinitely, so you don't lose it. you get to carry it forward.
Carry it forward. Okay, cool. Has there been any changes? It seems like that the 1031 rules pretty much was left intact. Is there any updates on the 1031 guidelines?
So the big update there is it's now limited to only real property. So then it begs the question, what happens to something that you relinquish the property in 17 and you're going to replace in 18? And they say that's okay, you can do that. That's still going to be a tax-free event.
So that would be things like art and airplanes and cattle.
Yes.
Yeah.
But apartments and office buildings and houses, those are all still pretty much status quo.
Exactly.
Real property. Yep.
Okay, cool. And then the other thing, which is of utmost importance to me, is the carried interest. Everyone keeps talking about the carried interest. Were there any changes to the carried interest? That was one of the things that they kept talking about, maybe removing it and making all the carried interest taxable. What was the final kind of verdict there? Taxes ordinary income. So what was the final verdict there?
So they left it intact aside from how long you're required to hold the property. So it used to be there was a 1-year holding period, and that has increased to 3 years. So if you buy and sell something and don't hold it for the full 3-year term, it's going to flow through it at the ordinary tax rate rather than the capital gain.
You carry interest portion.
Correct.
So if I was to co-invest in one of my deals, that would be treated as long-term capital gains if we waited a year. But the carried interest portion to be converted to long-term capital gains, it has to be 3 years.
Exactly.
Correct? Okay.
Yes.
A lot of these people that listen to the podcast are real estate people. What should they be implementing in 2018 to help for their 2017 taxes, and 2018, what do they have to do today?
I would say they should be doing what we're doing right now with our clients and working with their CPAs to calculate and estimate the impact of the QBI deduction. And because there's so many moving parts to the deduction, determine if they're going to get the deduction based on their current structure and current, level of wages that they pay out of the entity. And so, for example, the deduction could be very different between a sole proprietor, an LLC, and a limited partnership or an S corp. By virtue of the fact that, let's say you own a LLC and there's wages in the LLC, but LLCs can't pay wages to owners. So they can pay wages to employees, but not owners. And so if you need the wages to juice your QBI deduction, you may think about what structure you're in.
What other things should passive investors that invest in real estate should be thinking about going into 2018?
I don't think the deduction, at least the QBI deduction, I think they're going to actually do the same thing. I mean, they need to work with their CPAs to figure out what impact this is going to have on them.
Mm-hmm. Manny, anything else to add to what investors should be doing in 2018?
No, I mean, it's difficult to say. Everyone's situation is so unique. And so just to reiterate what Mark is saying, just go talk to your tax advisor. Look at your current state, what you're doing now. What does it look like for 2018 under the new law? And then start looking at tweaks that you can make if there are any.
I think this is primarily on the individual level, but was there any implications from a business standpoint with depending on what state you're located in? Because I know obviously the SALT deduction has been capped at $10,000, and that's been rumored to be pretty impactful for the people in Connecticut or California or New York with a high state income tax, and more beneficial to people in say Texas, like where we're based. Does there any of that affect the business side of the tax reform, or is that pretty much non-impacted?
I think it's non-impact. I mean, I think that impacts the individual taxpayer on their itemized deductions, Schedule A. There are a couple of interesting things there. So you're right, the SALT deduction has been capped. There are other things as well. So miscellaneous deductions. So an individual that pays a tax preparer used to be able to take that deduction, or an individual that pays investment advisors used to be able to take that deduction. Those miscellaneous deductions have gone away, including non-reimbursed employee deductions. The great news on Schedule A is that the P's limitations are gone. So the P's limitations used to really haircut.
And what is that? I don't know what that means.
P's limitations, it's basically another way to raise taxes. It's an overall limitation on itemized deductions for individuals once they get over a certain income level. And it's basically, the calculation is 3% times, I believe, adjusted gross income. So or 3% of adjusted gross income over $300,000. So if you make $1 million less $300,000, $700,000 times 3%, so your itemized deductions get haircut by 21%.
That's probably because I've never been that high.
So that's gone. So that's a good thing. So we used to look at Schedule A's for clients and go, this guy's not getting any itemized deductions.
Anything with the AMT, or is the AMT pretty much intact and survived this bill?
AMT is still intact, but the limits have gone up quite a bit. So over time, so the long story in the AMT, I think it was basically enacted in the 60s to prevent a very small population of taxpayers from avoiding taxes, and the limits and the amounts where people are subject to AMT never kept pace with inflation. So more and more people got sucked into AMT. So those limits have been adjusted up quite a bit.
So it should be helpful, and
it should be helpful.
A lot of people out of the AMT. And then one of the things back to the business that I heard about is you used to be able to deduct 50% of meals and entertainment, and now entertainment is no longer deducting. So you can't go golfing or take your clients to the Rangers game if you wanted, baseball game if you wanted to, and not get deducted. Is that right? So you could only deduct meals, not so much entertainment. Is that true?
Yeah, sure.
Cool.
So that means I can't take clients out for golf?
Yeah. So, okay, Paul, what else?
No, this is very enlightening. Mark and Mandy have wisdom that is really crucial right now. I mean, we make some of these borrowing decisions and these investing decisions based on the tax consequences that people have right now or are going to have in the future. So again, I didn't think, last year when we had the same discussion, I didn't think we were going to have a major shift in the tax law, but obviously it happened a couple of weeks ago, and we're just kind of feeling it out what's going on right now. How about the personal side? Anything change on the personal side besides the AMT and the self-deductions and the estate taxes? Anything else that people should be aware of for deductions, even for their personal taxes?
No, I think those are about it, Paul. I mean, the one thing we didn't touch on was the estate tax. Lifetime exclusion was effectively doubled. So there was a lot of headlines about eliminating estate tax, but at the end of the day, Congress doubled the exemption from $5.4 million to $11.2 million per person.
That's great. Mike?
That's really it. We definitely appreciate your time. And Paul, again, what do we have coming up in the Old Capital World?
February 15th, don't forget CoStar at Grapevine Convention Center. You definitely want to hear that economist. And March the 28th, Dr. Dotzer is coming in. But we always want to make sure that Mark and Mandy get their information out. So if there's anything that comes up, and I don't think it makes a decision where you live, if there's any questions that come up in the federal tax returns, and you guys do other states too, obviously.
Sure, we have clients all over the country and internationally as well.
Would you mind a call every once in a while to listen to some people?
Feel free to give us a call. Call me or Mandy.
What's the best way to find out information about you guys? Want to give out your website or a main phone number?
Yeah, phone number 214-696-1922. Our website, www.mckcpas.com. So Mac CPAs.
Some great information. Mark, Mandy, thanks for sending in. Thanks for enlightening all of us about what's going on, things that we should be aware of. Mike Becker, always a pleasure.
Thank you.
I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.